Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over some information that I haven't gone over for a little while. We're going to touch on kind of consumer price index, producer price index, the gold divided by the M2 money supply. We're going to look at kind of that information and data that I haven't gone over, in a while on either, I would say either the website or the channel itself. But I'll give you my financial opinions on it. I think that some of these charts look incredibly scary almost because they overlap, guys. Everything is interconnected. All right, it's all interconnected. And what that interconnectedness will tell us, if we can tie together this big picture, is what the market conditions will be in the future. Potentially what it will look like. And we can use all of this data to gain insights on what all of the individuals in the system think of the market. What they're basically doing is they're painting this Picasso, this picture of all of these interactions and all of it's the cumulative thought process or the cumulative interactions of all humans in the world trading on these exchanges are drawing these patterns, and those patterns is basically the code, or we can decode it using technical analysis to come up with potential, I don't know, not necessarily problems or solutions or anything like that. It just tells us a story. I'll put it that way. And maybe this story's right. Maybe it's not. These patterns I see all the time, over and over and over. And we'll go through a little bit in this clip of what I'm seeing. And I mean, I don't think it looks very. It's a little bit scary, a little bit terrifying to some degree. But let's dive in here. I'll show you what I got, and we can go over it together. And again, if you guys need any sort of help with anything, join our community at the Platinum membership, Finding-Value. Use quote discount code in the coupon code. Just discount. All right, let's dive in here. Let's see what we got. So what I've got first is the gold to M2 money supply. And I want, I think we need to understand a little bit about this. What this is telling us is if you're up here, that means that gold is accounting for the money supply in the system. If we're down here, what that means is that there's far more money in the system and gold has not accounted for it. So anything that's below this line is ultra cheap down here. Anything above, I would say, maybe this up here is starting to get expensive up here. And then the average is somewhere in between. Now, what I looked at here is the question that you should have is, one, are we cheap or are we expensive? We are incredibly cheap with this ratio of gold divided by the M2 money supply. We're very, very cheap. The second question you should ask is, what causes this ratio that I have here? What causes it to go up and down? What caused this? What caused this? What caused this? And what caused this? And what I have gathered with the data that I've looked at in my things looking at all this here was an energy crisis tied with a larger demographic, which meant that we had more money coming into the system. It was a credit expansion phase tied with an energy crisis. And what I think is coming is the same type of condition that we had in the 1970s. I'll just say 40s, 50s, 60s, 70s, that type of condition. I don't want to argue the exact time frame and the exact period, and this wasn't doesn't matter, guys. Energy crisis, expanding credit. I think that's coming over here. And when I look at these patterns, I see the same pattern over and over and over. It's something that I look for. It's something that I use to invest. And when I get certain alignments with ratios and all these other things, I go heavy and really lean into a position when everything's in alignment. Now, I see the pattern in this gold to M2 money supply ratio. I also think that the same market conditions that created this revaluation of gold in relationship to the money supply is also coming up over here, where gold's going to account for the money supply. And the reason gold accounts for the money supply during these time frames, it's not that people just want gold out of nowhere. It's people want gold because nothing else works in that environment. No other investments do very well. Back in the 1970s, commodities and precious metals did very well because there was constraints in energy. Constraints in energy led to a currency. People were worried about the currency. And I think what's coming ahead of us is going to be something very similar. We've got a whole bunch of money in the system. I think that the interest rates going up, the debt that has to be created to cover the interest payments. And then you also have baby boomers going in retirement age, collecting Social Security and all these other things, which will also run deficits based off of the obligations in the system. Money's going to have to be created, which will be an inflationary period. I also think that if you don't have accompanying growth with that inflation, growth of GDP, that we're going to have a problem. And if we look at, let me touch on that real quick before we dive into this. I know I've got that somewhere here real quick. What that is, oh man, it's down here. I know I've got it. It's the M2 money supply divided by GDP. And what this is this is just your money velocity is what they call it. Really, it's the money stock in relationship to your gross domestic product. Your gross domestic product, if your M2 money supply outpaces it, it means that money is in the system. And what accounts for the money in the system, like how we account for this, it just all was printed and went into financial assets. And what happened was, if you look at the ratios of financial assets versus commodities, you can see the money is clearly over there. And we were at a 100-year low for commodities or a 100-year high for stock investments. That money is in the system, but it all went into financial assets. And, no one really cared that it went into financial assets because it was something where people got richer, but no one really cared because it didn't impact the normal person. They didn't see it in the consumer price index. Their cost of certain things didn't go up. We were in a disinflation period, and this money was created and it was put into the system. Now this money's rotating. It's rotating into commodities. We have constraints in the system where we can't grow infinitely energy or commodities. So we've got a constraint in the system which will constrain GDP, which is in your denominator. Your numerator, which is your money supply, which is this M2 money supply, that's what making it go up. I think this is going to stay on. We're going to continue to increase the M2 money supply based off of the design of the system. So if I were to go back, if we know that this thing exists here where we've created all this money, it's going to rotate over. What happens is, during these big, long periods where we've got the gold divided by the M2 money supply, here's a big long period here. This market condition basically forced the money that was in stocks and bonds to rotate into commodities and precious metals. Increasing interest rates, which is inflation. Inflation is what's driving that. And I think what's coming up is an inflationary period, which is going to drive money into precious metals, into hard assets, and into commodities because of the same market conditions that happened in the 70s. An inflationary period where a real negative rate will have bond sell-off. And on top of it, we're also going to have a demographic that is a baby boomer coming into retirement age and the millennials coming into home buying years. That combination, I think, will push this higher. Now, when I look at this pattern here, what I normally see is I see a pattern that does this. It kind of does this. It goes sideways. Then you go into the valley of despair and you create a double bottom. Then you come up, it'll go like that, and then it'll run higher. this I see over and over and over. If I go to Ethereum, I'm just going to take it because it has a real clean chart of what I'm describing. So what I'm describing is this move higher and then the pullback here. This is one cycle. It's this up cycle and then the recession and then the recovery phase, and then we go back into an expansion of the stock. So if I were to take this and I'm going to copy this, and all this is just a copy of that pattern right there. I'm going to go back to the gold to M2 money supply. I'm going to back out and show you kind of the big picture view. I'm going to paste this on here. And hopefully we can see this. We're going to go logarithmic. I'm going to have to go and shrink this up a little bit. All right. So what this is you can see, I'm going to line up this portion here to show you guys what I'm talking about. The move in the up move is this move here, and you can see that we pulled back and moved up. This is the up move. And then if I'm going to tie the down move, what you're going to see, and this is obviously spread way out compared to the other pattern here, is you can see that this guy, the way that this fell is the same way. I have to blow this way up, guys. Let me re-hit it here. Something on the lines of that, right? And it's not going to be perfect, but the same rough selling points all happen, and you get this pattern here. And we are at what I think is a very close bottom call here for gold to the M2 money supply. So you can see that this thing is very close in the way that this thing moves. You can see it all through there. I'm just kind of showing you guys how this all lines up. What I think this is doing is I think gold's putting in a double bottom. And we are at a very favorable spot for that double bottom where we'll go on up. And this is the 2020 shutdown here. So we may not get that shutdown. It may just continue to go higher. Or maybe they're going to try to shut it down and try to stop this. That's what they're doing in China. They could do it in other things. They're going to try to slow this thing down. The only way you can stop it is to shut things down. But given the market conditions, what I think is going to happen is that this is going to go higher. It's probably going to break and do this, or right underneath it, or something on that lines. And then we're going to go higher here to some level. I don't know what the level is yet, but it's just higher. What that is telling us, if this is actually true, and we have this type of pattern, and it's going to go up, and it's going to be a double bottom, which I always see as this little, double bottom type movement, is that gold's going to outperform the M2 money supply. And the market conditions of the 1970s is going to be something similar to that, is what this pattern is basically scribing out. And what that means is that we're probably going to have a constraint in commodities, whether it be minerals or energy-based. If it's energy-based, which we can obviously see based off all the data I cover on the channel here. We also know that there's very big shortages out in the future for minerals, copper, zinc, all that type of stuff. So that all aligns. It aligns with this gold to M2 money supply and all of the things that we look at from market deficits. So what I think is going to happen is this is going to come up, it's going to go on up. What this means is that we're going to be going into a highly inflationary environment. Highly inflationary environment is what this is basically telling us. And we are still super early for an entry point for even gold. And this may not even be done yet. I mean, maybe we've got a couple more things to go before we rocket higher. But big picture view, that's what's going to, what it looks like to me is painting. This here was also another inflationary environment where people came into home buying years, home prices went up, inflation, interest rates started going up. It's the same thing here. So this was the big one. This is another one. And then I think we're going to get another one coming on higher here at any point. If that is the case, and I'm right there, which also matches your M2 to GDP, which means that this money that's all created out here is going to come back down. Your money velocity is going to go up, is what I think is going to happen. And I think that's why Powell is afraid. We can also look at the PPI, Producer Price Index. And the Producer Price Index since 1950s has been going down and down and down and down and down. What this is basically telling us is that we are becoming more efficient at producing items in society. That we can extract energy at greater quantities and convert minerals into usable products more efficiently over time. Now, if we look here, we kind of have this like double bottom. We have this double bottom and it's coming on up. We hit our head here. They released a whole bunch of Strategic Petroleum Reserve releases. They locked down, the COVID lockdowns for China and all these other things. Now, I'm wondering if this is going to break to the upside of this PPI to CPI ratio. If it breaks to the upside, it means that the Producer Price Index is going up at a faster pace than your CPI, which is basically means it's inflationary. The 1960s, 70s was here. This was the 2000s. And then this one here is what happened just recently. And this is a ratio. It's just a ratio comparing the two. So I do think that this could potentially heat back up when oil goes up. Oil is the number one commodity. Silver is the number two commodity. And those have what I consider to be the most utility. One thing that I notice in this chart is I can draw a big line across here. And remember when I talk about those patterns that I see, the inner move, and then the double bottom, and then the break higher, the move sideways, and then the move higher. Well, I see that same pattern here, which means that we could see a highly inflationary environment ahead of us. It has that same pattern. And it's the same pattern that is scribing out, except we're somewhere down in this range down here. I think we're probably like right in this range there for gold versus the M2 money supply. That's gold versus M2. You can see that move there. We go back to the PPI. That's what basically that move there. And it doesn't mean that you do a double bottom completely. This guy can be a little bit lower. It could be a little bit higher. It's not, it doesn't, that's not the big deal here. But this has that double bottom I've seen, and it's consolidating. This double bottom is found basically everywhere. It's in rare earth metals. It's in copper. It's in, all these different patterns that I'm seeing. They all have this double bottom, and that's on a far different thing. But there's your lead in, your double bottom, your move higher. You usually get some sort of flag pattern or a pennant formation or something that breaks to the upside and runs. And to me, it looks like we're ready to run at any second. Copper's bouncing off that support level. REMX also has it. So I'm seeing this everywhere. It's not just one area. So I think that we're bottoming here. We can go far higher than where we are at today. And the PPI to CPI ratio is also putting in that big double bottom that I normally see. It even has the same type of drop, the same type of drop here, the breakout of basically this line there. If you connect it, and then it rolls on higher. So it's very interesting that I'm seeing all this and how it's all interconnected. We also have the interest rates. This is the inflation rate year over year. And what's crazy here is this is all the way back to 1915. We have a trend line, and we are basically breaking out and retesting the trend line right now, which means this could go dramatically higher at much higher inflation rates. This is a long decline in inflation rate based off of productivity growth. Now, if something happens to your energy source or something happens to the minerals, this is going to rocket higher. And I think it's coming. And it could be coming now. It could be coming in 6 months. It could be coming in 1 year, 2 years. I don't know the exact timing, but I think it's coming. based off of all this different information that I'm showing you. And if you were to take something like the 10-year yield and you back out, and what's crazy is we got the downtrend line and we've broken that downtrend line. We have a new shift to increasing interest rate environment, which means inflation. That's also interconnected with this. That's why we have the big breakout, and we did a breakout, a retest. We're coming on up, and we're going to have pullbacks. That's not uncommon. I call it stair stepping. So you come up and you stair step higher. And that's exactly what we're seeing. So everything's in alignment here. And even your CRB to S&P 500, we had the big down move. And right now we're having a pullback. This is the first leg of that big move. And then the third leg is gigantic. That's the largest move out of all of them. And that could start at any time. I don't know if it's going to happen now. I don't know if we come back here and do it. I think it's kind of irrelevant to get the timing. You're not going to get the timing exactly right. No one's going to. But I'm just watching all this, and it's kind of scary because it's all interconnected. And I think it's probably going to happen over the next 5 to 10 years. We're going to have a highly inflationary environment. I think that's also why Powell's trying to get the interest rates up. He's trying to get ahead of it as best he can, even though he's a little bit behind it. So I wanted to share that with everybody. So the thing to kind of walk away here from when looking at all these different charts is I'm seeing these big double bottom charts. It's going to take time to play out. It's not going to be fast. We're talking years, not months, not weeks, years, maybe even a decade or two. But the big trends in place and the things underneath us are shifting. Like we're talking paradigm shift type stuff, not you can't really look backwards at the last 40 years and project forward because those trends they're broken. And it doesn't mean that we go straight up. It doesn't mean that these trends can't look like the old times. And it doesn't mean that we're just going to go straight higher. We're going to have crashes. We're going to have cyclical pullbacks and these big, large moves in what I think are going to be commodities, big, large moves in commodities higher. And stocks and bonds are going to come under pressure for a longer period of time. And to me, it looks like everything's lining up for that to happen. So just wanted to share that with everybody. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. Subscribe to the website if you like. If you guys need help, there is a quote discount. That's the coupon code discount. And you can sign up and you get a larger discount on the yearly membership versus the monthly. And we talk about all the companies that we're going to be playing with for long-term investments. Some of them deals with the reserves that they have. How many years worth of reserves do they have? Are they in an exporting country? And when you're in an exporting country and you've got exports and you can still export, that'll be the most valuable things in the world because everyone else is consuming it. They're not going to be able to export, and everyone's going to be fighting over what's left of the exports. So that's what I've got. Hopefully you guys liked it. We'll catch you next time. This is Finding Value.